Well, mixed messages on what we know about the Greek debt crisis. The Greek central bank governor has told Bloomberg that he's confident the government will meet its deficit reduction goals. George Provopoulos says they, and I quote, have to succeed to ward off any further credit rating downgrades. But the markets are not buying into that, with the euro continuing its roller coaster ride. In fact, derivative traders are signaling that the euro slump to a 9-month low will continue even if the EU bails out Greece. Well, to discuss all this, I'm now joined by an expert, Jane Foley, research director at Forex.com. Good to have you on the show. As always, Jane, you said in recent papers I saw on the internet, on the website, that you actually expect the euro to slide further. How far can it drop, and what happens mid-March?
Well, I mean, on the first question, we've got forecasts out there now, again, for parity. And, you know, if you look at the long-term forecast of euro-dollar, we will see that right now at 136, we're really still at a fairly strong level for the euro. The long-term average for euro-dollar since the exception is closer to around about 118, 119. So certainly we could fall back to there. And to be honest, you know, it really depends how this situation is handled. But I wouldn't rule out parity at this point just yet. And that is because these issues with regards to the fiscal problem, they're not just about Greece. These are problems with respect to fiscal coherence in EMU that were always there in the run-up to 1999. It's just taken this recession to uncover those cracks.
And obviously, once Greece might be sorted out, we're far away from that. Then there are the issues in Portugal, then there's Spain, and then there's Italy. Managing such a diversity was always going to be difficult from the start. How do you think this will pay out further down the road in terms of monetary policy? Will the ECB have to hold off to raise rates in order not to punish further those countries with fiscal problems?
Well, I mean, I think it will be holding off from raising interest rates for a long time anyway.
Well, fourth quarter at the moment is kind of the guess in the market, not before that.
Not before then, and possibly even beyond that. And even if you take
because of that situation?
Not necessarily because of that situation, but even if you take away all of those problems and you look at the inflation data from the core European countries, there really isn't much inflation at all. In fact, you strip out the impact of stronger oil prices, and you could really be saying, well, maybe actually there's more deflation there. So from just a pure economic argument, there really isn't much reason to be hiking interest rates. But, you know, you add to the mix these issues, and there really isn't any reason to expect the ECB may not even hike interest rates this year.
Let me throw into the mix an interesting headline I picked up in The Guardian on Friday. They are writing that the cost of gambling on the euro is the price of a cup of coffee at Starbucks, pointing to the fact that it costs about £1 to short about £1 million worth of currency. So is it really fundamental issues that are driving the euro down, or is it also, you know, it's quite attractive to be part of that gamble?
Yeah, I mean, it's everything. I mean, it's the Greek issue is you know, part of well, it's been a massive part of the you know, what's going on this year in the foreign exchange market. But you add to that, you look at the US fundamentals. Now, these have been ignored to a large degree in the last couple of months, and which is in contrast to, say, last year. But the US data has been coming out on the firm side these last few months. There's every reason to expect that the Fed will be out of the interest rate hiking traps well before the ECB, well before the Bank of Japan. And for those reasons, you know, there's less reason to use the dollar as the funding currency.
Let me also look a bit further at what's happening at the euro end. At the moment, it seems to be a euro-driven story, not so much a dollar-driven story, despite the Ben Bernanke will be obviously in the headlines in the midweek. But at the moment, we see those record short bets against the euro at levels never seen before for various reasons. Do you think that could actually go even further and really push the eurozone to a certain edge? One person who should know about that kind of short bets, George Soros, he said the euro could actually fall apart.
It could possibly. And if you think about EMU, it's a monetary union. You get back to the academic argument, which is always there. Can you really have a monetary union without fiscal union? Now, we can't have that in Europe because you would be giving up sovereignty of these different countries. So it's a political no-go. But really, can it be sustained?
We're back with politics here. Mid-March, what can happen? Carrot-stick approach by the EU. What can they actually do to force Greece to rein in their deficit?
This is it. I mean, Greece at the moment have said, oh, you know, that they'll freeze public sector workers. But in order to improve their competitiveness, they should have two things. And one is either cutting wages massively, which is very difficult to do from a political point of view, and the other is to devalue their currency, which, of course, they can't do that either.
So it would actually be feasible for Greece to drop out and go back to the drachma?
You cannot rule that out right now.
So this is actually something the market is looking at, which is why we're seeing the euro drop.
Precisely. The market's looking beyond the initial problems. And if you think about it, Greece is now paying the price with higher funding costs for long-term debt. And that takes away one of its major incentives for being in the system.
So something we will still be discussing. Thank you so much, Jane Foley there from Forex.com.